Welcome to a journey where the wisdom of books transforms the complex world of investing into an accessible path to financial empowerment. In this adventure, we've distilled the essence of 10 transformative investing books into 10 pivotal lessons that promise to reshape your understanding of wealth creation. Imagine uncovering secrets that the financial elites have guarded for centuries, now laid bare for you to discover. Did you know that if you had invested just $100 in the S&P 500 50 years ago, without adding another penny, that investment would be worth over $12,000 today? This is the power of compound interest, a force so potent that Einstein dubbed it the eighth wonder of the world. Yet, this is just the tip of the iceberg. In our exploration, we'll dive deep into the core principles that drive the stock market, unearth the psychological battles waged in the minds of investors, and navigate through the misty paths of value and growth investing. We'll reveal how diversifying your investment portfolio is akin to an ancient art of balancing risk and reward, and why bonds, often overlooked, are the silent guardians of your financial well-being. We'll also step into the tangible world of real estate investing, a realm where bricks and mortar hold the promise of passive income and capital appreciation. But that's not all. The impact of taxes on your investments and the strategic craftsmanship required to build and manage a robust investment portfolio will be laid bare, offering you a blueprint to financial success. This isn't just about investing, it's about unlocking a new perspective on wealth, arming yourself with knowledge that transcends the fluctuating waves of market sentiment. It's about building a legacy, one investment at a time. So, are you ready to embark on this enlightening journey? To peel back the layers of financial jargon and uncover the investment strategies that can lead you to financial freedom? Join us as we delve into the lessons gleaned from reading 10 seminal investing books, each chapter a stepping stone to mastering the art of investing. Let's turn the page on traditional investing advice and chart a course through the transformative power of knowledge. Because in the world of investing, knowledge isn't just power, it's profit. Let me know if this sets the tone you're looking for and if you're ready to move forward. Chapter 1. The power of compound interest. Imagine you plant a single seed in your garden, and over time, that seed not only grows into a tree but also starts sprouting new seeds. Each of these new seeds grows into more trees, which then produce more seeds, and so on. This is compound interest in the world of investing, a simple concept with powerful outcomes. Albert Einstein didn't shy away from calling it the eighth wonder of the world, for a reason. It's all about earning interest on your interest, leading to exponential growth of your wealth over time. Now, let's break it down with a real-world example. Suppose you invest $1,000 at an annual interest rate of 5%. In the first year, you earn $50 in interest, making your investment worth $1,050. If you reinvest this amount, the next year's interest is calculated on $1,050, not just the original $1,000. Over 20 years, without adding any more money, your initial $1,000 investment grows to about $2,653. That's over 2.5 times your original investment, all thanks to the magic of compound interest. But here's where it gets even more interesting. The longer you leave your money invested, the more dramatic the compounding effect becomes. It's like a snowball rolling down a hill, gathering more snow and momentum as it goes. This is why starting early can make such a huge difference. Even if you can't invest a lot at first, the power of time and compounding interest works in your favor. Many people overlook this concept, thinking they need to have a lot of money to start investing. However, the truth is, even small amounts can grow significantly over time. It's not just about how much you invest, it's about how long you let it grow through the power of compounding. Remember, the key to harnessing the full potential of compound interest is patience and consistency. Regularly contributing to your investments and giving them time to grow can lead to astonishing results. It's a simple strategy, but its power cannot be underestimated. By understanding and applying this principle, you can set yourself on a path to financial independence. Chapter 2. The importance of diversification. Diversification might sound like a complex financial term, but its concept is beautifully simple and incredibly effective. Think of it as not putting all your eggs in one basket. In the investing world, this means spreading your investments across various asset classes, such as stocks, bonds, real estate, and more. Why? Because it can significantly reduce your risk and smooth out your investment returns over time. Here's how it works. Different investments react differently to the same economic events. When stocks are down, bonds might be up, and vice versa. By diversifying, you can protect yourself from losing everything if one investment or market sector takes a hit. It's about balancing your portfolio in a way that one investment's poor performance is offset by another's gains. Let's use an analogy. Imagine you're at a potluck dinner. Instead of filling your plate with just one dish, you try a little bit of everything. That way, if one dish doesn't taste good, your entire meal isn't ruined. Diversification in investing works the same way. By spreading your investments, you reduce the impact of a single underperforming asset on your overall portfolio. Historical data supports the benefits of diversification. For instance, during the 2008 financial crisis, while many stocks plummeted, certain asset classes like government bonds and gold performed well, cushioning the blow for diversified portfolios. This doesn't mean you won't see fluctuations in your investment value, but diversification helps manage volatility and reduce the risk of significant losses. Furthermore, diversification isn't just about mixing different types of investments. It's also about varying within those categories, investing in a range of industries, geographical locations, and company sizes. This strategy can further enhance the resilience of your portfolio. For example, while tech stocks might be suffering, healthcare or consumer goods stocks might be thriving. In essence, diversification is a critical strategy for any investor looking to build and protect their wealth over the long term. It's a reminder that in the world of investing, sometimes, spreading your bets can be the smartest move you make. By diversifying your portfolio, you're not just investing in a range of assets, you're investing in the peace of mind that comes with a more stable and resilient investment strategy. Chapter 3. Understanding the stock market. The stock market often seems like a complex web of numbers, trends, and jargon, but at its core, it's a marketplace for buying and selling shares of publicly traded companies. Think of it as a giant global network where anyone from individual investors to large institutions can participate in the economic achievements of businesses worldwide. Understanding how it works is the first step toward making informed investment decisions. One of the fundamental concepts to grasp is the difference between stocks and the stock market. A stock represents a share in the ownership of a company. When you buy a stock, you're essentially buying a piece of that company. The stock market is where these shares are bought and sold. Prices fluctuate based on supply and demand, essentially, how much people are willing to pay for a share versus how much sellers are asking for. Long-term investment strategies often come into play when discussing the stock market. Historical data shows that despite short-term volatility, the stock market has trended upwards over the long term. This is why patience and a focus on long-term growth are emphasized by successful investors. It's not about timing the market perfectly, it's about time in the market. Market volatility can be intimidating. Prices swing daily based on news, economic indicators, and market sentiment. However, this volatility is a normal part of investing in stocks. Rather than reacting to short-term fluctuations, successful investors maintain a long-term perspective. They understand that the market has periods of highs and lows, but over time, it has historically provided positive returns to those who stay invested. Investing in the stock market also involves doing your homework. This means researching companies, understanding market trends, and keeping up with economic news. But it's not just about picking winners, it's about building a diversified portfolio that can withstand market ups and downs. Lastly, remember the importance of starting early. Thanks to compound interest, even small investments can grow significantly over time. The key is consistency and a willingness to learn and adapt as you go. The stock market is not a get-rich-quick scheme but a tool for building wealth gradually. Chapter 4. The psychology of investing. Investing is not just about numbers and economic theories, it's also a psychological endeavor. The emotions and behaviors of investors play a huge role in the dynamics of the stock market. Fear and greed, in particular, can drive market swings and lead to irrational decision-making. Fear can cause investors to sell their stocks during market downturns, often at a loss, driven by the worry that they will lose even more. However, this fear-based selling can prevent them from benefiting from the eventual market recoveries. On the other hand, greed can lead investors to take on too much risk during market highs, hoping to achieve high returns quickly, which can result in significant losses when the market corrects. The concept of behavioral finance studies how psychological influences and biases affect the financial behaviors of investors and financial analysts. Common biases include overconfidence, where investors overestimate their knowledge and ability to predict market movements, and confirmation bias, where they seek information that supports their preconceptions while ignoring contrary evidence. To mitigate these psychological traps, one effective strategy is to adopt a disciplined investment approach. This includes setting clear, long-term financial goals, establishing a diversified portfolio aligned with your risk tolerance, and sticking to your investment plan regardless of market volatility. Automating your investments, such as setting up regular contributions to your portfolio, can also help remove emotional decision-making from the process. Another key aspect is to maintain a level of emotional detachment. It's important to stay informed and make adjustments to your investment strategy when necessary, but avoid making impulsive decisions based on short-term market movements. Remember, investing is a marathon, not a sprint. Understanding the psychological aspects of investing can empower you to make more rational, informed decisions. By recognizing and managing your emotional responses, you can navigate the complexities of the stock market more effectively, avoiding common pitfalls and working steadily toward your financial goals. Chapter 5. Value Investing Principles. Value investing is a strategy that involves picking stocks that appear to be trading for less than their intrinsic or book value. Think of it as shopping for a bargain in the stock market. This approach is based on the idea that the market doesn't always reflect the true value of a company due to short-term factors, such as news events or temporary market sentiment. Over time, however, the market will recognize the company's true worth, and the stock price will adjust accordingly. The roots of value investing trace back to Benjamin Graham and David Dodd's classic text, Security Analysis, published in the 1930s. Graham, often known as the father of value investing, and his famous disciple, Warren Buffett, have been vocal advocates of this approach. They look for companies with strong fundamentals, like a solid earnings track record, low debt, and a sustainable business model, but whose stock prices are undervalued by the market. One key metric value investors often use is the price-to-earnings (P/E) ratio, which compares a company's stock price to its earnings per share. A low P/E ratio may indicate that a stock is undervalued. However, it's not just about buying cheap stocks, it's about finding quality stocks at a lower price than their inherent value. Warren Buffett famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This encapsulates the essence of value investing. It's not just about finding cheap stocks, it's about finding fundamentally strong companies at a good price. Patience is crucial in value investing. After identifying and purchasing undervalued stocks, investors may need to wait for an extended period before the market recognizes the company's true value and the stock price increases. This approach is not for those looking for quick gains but for investors who are willing to invest with a long-term perspective. Value investing also requires diligent research and analysis. Investors must look beyond the current market sentiment and evaluate a company's fundamentals, such as its financial health, competitive advantage, and future growth prospects. It's a methodical approach that seeks to minimize risk and capitalize on the market's tendency to overreact to short-term events.